Students, welcome you all once again in the live virtual classes organized by Board of Studies of ICAI. Students, today we will be covering three important standards: Ind AS 2, Ind AS 23 and Ind AS 36. The first one is on inventory, the Ind AS 23 is on borrowing cost, and Ind AS 36 is on impairment of assets. So we have covered these three standards in detail, and we have spent one class on Ind AS 2 in the last batch, one class on Ind AS 23, and two classes on Ind AS 36. So in total, we have spent four classes, right? And we have already took 12 hours for covering these three standards. And now, since today is a query session, which will cover these three standards, and we will do the revision, we will touch upon on the important concepts on all these three standards in the next 3 hours. So largely in the next 2.5 hours, I'll cover the concepts. I'll run through the PPTs, which I have presented in the last batch. And then then the students will be unmuted. And if anyone has any query, you are allowed to ask any question relating to these three Ind AS. So let's start with Ind AS 2. Ind AS 2, which is the inventory related standard. Ind AS 2 talks about the accounting treatment of inventories. And students, as I told you, accounting includes recognition, measurement, presentation, disclosure, RMPD, right? So this Ind AS 2 talks everything about accounting treatment of inventories. This standard includes all inventories except work in progress arising from the construction contracts, because this WIP arising from construction contract is included in Ind AS 115, revenue from contract with the customer. This Ind AS does not include inventory relating to financial instruments. If someone is trading in stocks, right? In that case, this standard is not applicable. Biological assets related to agricultural activity and agricultural produce at the point of harvest, this standard is not applicable. Ind AS 41 is applicable. And measurement of inventories held by producers of agriculture produce after harvest, and commodity broker trader measuring inventories at fair value less cost to sell. So in these four aspects, Ind AS 2 is not applicable, but otherwise Ind AS 2 is applicable to all the inventories. Now, what is the definition of inventory? Inventories are assets, right? Stock and trade, assets, which is held for sale in the ordinary course of business. Held for sale in the ordinary course of business means this is talking about your finished goods. Finished goods. Okay. In the process of production for such sale, in the process of production means WIP, work in progress. Work in progress. Or in the form of material or supplies to be consumed in the production process or in the rendering of service, means it is talking about raw material. For example, Maruti Suzuki India Limited is manufacturing a car. For manufacturing a car, Maruti needs plastic, fiber, wiring, steel, iron, sheets, battery, right? So Maruti needs a lot of raw material, glass, okay, paint. So Maruti needs a lot of raw material, right? And this entire raw material needs a assembling, okay? So the name which I have taken, plastic, fiber, glass, wiring, battery, stereo, these all are the raw material for Maruti, which is directly related to the production of these cars. Okay. Is this the only raw material? While doing a production, Maruti needs lot of spares, consumables, grease, oil, lubricants, right? Lot of these things are also required while incurring into the production process, right? So friends, these small items, these consumables are also part of the inventory. So when Maruti got all these raw material, Maruti will spend some time in assembly line, while assembling all these items so that it will have a shape of a car. So that process is known as a work in progress, right? So after raw material, when Maruti is processing the labor, some material, consumables, so that stage is known as a work in progress. And when the car will become ready and it is ready for sale in the ordinary course of business, it will it will be classified as finished goods, right? So this standard includes finished goods, work in progress, and raw material. Some key points relating to inventory. Inventories may include intangible assets that are being produced for resale. For example, software. Friends, the cars for Maruti Suzuki India Limited is inventory. But car for me, car for you, car for TCS, car for Infosys, for these companies, these cars are property, plant, and equipment, right? So, friends, inventory could be anything. For example, flats, houses, land, plot for DLF, for Signature Group, for Godrej Properties. These are inventories, right? For us, these are the property, plant, and equipment. Likewise, SAP, Microsoft ERP, TCS, Infosys, for these company, software are inventory. Software are also inventory, right? So inventory could be any item which is in the form of generally PPE, intangible asset, but the company which is dealing into these kind of a PPE or intangible asset, these kind of items are inventory for that company, right? In CA final, the CA final is not only limited to the theoretical knowledge. In CA final, if you read your curriculum, it talks about, working knowledge, or it talks about kind of a application level knowledge. So let's say there is a question which came into your exam, and the question says that ABC Limited is in the manufacturing of cars, right? ABC Limited is in the manufacturing of a cars, and ABC Limited has 5 cars which are there in the stockyard. The cost of the cars are 5 lakh rupees. Okay. And since due to COVID or due to some other circumstances, the demand of the car has gone down, and the net realizable value of the car becomes, 4 lakh rupees. Okay. And they have 2 more cars. So in total, they have 7 cars. 5 cars they are available for sale. The 2 cars they are using for their own purposes. 2 cars they are using for picking the customers, dropping the customers, right? Or using those cars for their company purposes. Their executives are using those cars, their employee are using those cars, right? The cost of this entire fleet of car per unit is 5 lakh rupees. The NRV is 4 lakh rupees. So compute the closing value of the inventory as on 31st March 2024. I believe the question is pretty straightforward. I believe you have understood the question. So generally what happens, we are not thinking about what is the usage of that particular item in the books of that company. While I understand that this company is into the manufacturing of cars or into the trading of the cars, right? But at the same time, if that item is available for sale in the ordinary course of business, it will be classified as inventory. But if that item is used for the business purposes, it will be property, plant, and equipment. So for Maruti Suzuki India Limited, the 2 cars will be classified as property, plant, and equipment. The 5 cars will be classified as inventory, right? And the standard for inventory is Ind AS 2. The standard of PP is Ind AS 16. In the last class, we have discussed Ind AS 16. It talks about measurement of inventory at cost model, at cost, right? Initial measurement, subsequent measurement. So while doing a subsequent measurement, you can apply revaluation model, but it is not mandatory. It is an accounting policy choice. So in this question, how you will handle this question? Generally, I have seen when I ask these questions to CA final students, they will say that, sir, there are 7 cars. The total value of the 7 car is 5 lakh multiplied by 7, 35 lakhs. NRV is 4 lakh. 4 lakh multiplied by 7, 28 lakhs. So the total value of 7 car is 28 lakhs, which is wrong. Cost or NRV, whichever is lower, is applicable for inventory. Cost is applicable for PP. So these 5 car has to be classified as inventory and the value will be 4 lakh multiplied by 5, 20 lakhs on the basis of cost or NRV, whichever is lower. For 2 cars, it will be classified as PP and the cost is 10 lakh, right? It will not be reduced to the NRV because the intent is not to sell the asset. Intent is not to sell the asset. Understood? Right? But if the market value has substantially gone down, the company has to see the impairment testing. The company has to check the impairment. Okay. And these 2 cars are subject to depreciation also. This inventory is not subject to depreciation. I hope this is clear. So in CA final, these things are very, 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 very important, right? That what is the usage of that asset in the books of the inventory, in the books of the company? Is it an inventory? Is it a PP? Is it an investment property? Is it a biological asset, right? And for each different item, there is a different standard and there is a different measurement criteria. I hope it is clear to all. Any question on the chat box? Yes. Inventory also includes properties that have been purchased or are being developed for resale in the ordinary course of business, like for Godrej, DLF, Signature Plus. For all these companies, if they are purchasing inventory, they are purchasing properties for the purpose of developing, for the purpose of resale, it is an inventory for them. Spare parts, standby and servicing equipment, for example, tools and consumable lubricants, are classified as inventory. You remember in PP standard, I have talked about spare parts, standby equipments, servicing equipment. These are classified as inventory until and unless it is expected to be used for more than 1 year, for more than one period, right? In factory or in plant, in your articleship period, you guys must have seen, while running a plant, there is a lot of spare parts, there is a lot of standby equipment, servicing equipment, a lot of consumables are required, and these consumables are inventory. Grease, oil, lubricants, right? Bearing, okay. So wirings, all these are considered as an inventory. Reusable and returnable packaging or parts that are sold to a customer but will be returned to the seller to be reused are not inventory if the item will be used during more than one period. So there are two concepts, primary packaging material and secondary packaging material. Let's say you guys must have seen Amul milk, Amul Parag, Mother Dairy milk. So how you, when you go to the market, so how will you purchase the milk? Will you get your container and will you get the milk filled in the container, or you just go to the market, go to the shop, and the shopkeeper will give you that packet of milks? He will give you a packet of milk. So this packet is important. This packet is important for storing this milk, right? And it is known as a primary packaging material. You guys have seen the Maggie packets. The wrapper of Maggie is important to store that Maggie so that it can be reached to the customer. You guys have seen the chocolates, right? Dairy milk. So that the wrapper in the dairy milk is important to store that dairy milk so that it can be sellable. It can come into the sellable condition. So the primary material which is used for the storing of that particular item so that it will come into the sellable condition is known as a primary packaging material. and primary packaging material is a part of the inventory, right? What is a secondary packaging material? For example, the company is selling milk, okay, and the company is selling this milk. Of course, the packets are there, and the packets are stored in a container. The packets are stored in a container, okay, which is a refrigerated kind of a container, and the company is providing this milk in those container to the shops, and this container is returnable container, right? It's a returnable container. It will be used for multiple times. That plastic packet will not be used for multiple times. I'll go into the market, purchase the milk into that plastic packet, and it will be threshed out, right? It will go to the dustbin. It will not be reused. But that container, the company has to return to the manufacturer. Okay, it will be used for multiple times. So these kind of reusable and returnable packaging or parts will not be classified as an inventory. It will be classified as a PP or some other thing, right? So I have discussed that inventory has to be measured at cost or net realizable value, right? But what is meant by cost? Initial measurement is at cost. Initial measurement will always be at cost. Now, what is the cost? Cost means cost of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. Cost of purchase. What is cost of purchase? Cost of raw material, right? So, what is cost of conversion? Labor, the other other ancillary materials means the consumables, okay? And the other costs incurred in bringing the inventory to their present location and condition. For example, if you have to, if you are in the manufacturing of a whiskey or a liquor, let's say, for a whiskey, it requires a long gestation period. It requires a lot of storage. It requires a lot of storage, right? So the storage is part of the process of manufacturing that whiskey. In that case, the storage cost is important to bring the inventory in their present location and condition, right? To make it sellable. So that storage cost will also become part of the cost of the inventory. Okay. So it includes cost of purchase, cost of conversion means processing cost, and the other cost as well. What is my cost of purchase? Cost includes the purchase price, transportation, like in PP we have discussed now, purchase price plus import duty plus non-refundable taxes minus trade discount and rebates. The same concept is there also, right? If you are into manufacturing of certain goods and services, you went into the market, purchases the raw material, you have paid GST on that. GST is non-refundable. For example, in that case, it will become part of your cost of inventory. But if GST is creditable, it will become part of your asset, your input credit. Okay. So deferred payment. In PP, we have discussed this concept of deferred payment also. In case of deferred payment, means when the payment is deferred beyond normal credit terms, right? In that case, it will be considered as a finance cost until and unless it will be capitalized in the inventory standard. It will be capitalized in inventory as per Ind AS 23 borrowing cost standard, right? So you remember the concept of capitalization of interest comes from the borrowing cost standard, which talks about qualifying asset, right? And the next standard is borrowing cost standard. So friends, this is the concept of cost of inventory. What is my cost of conversion or production? Cost of production or conversion includes all the direct costs, such as labor, right? Some labor is required for the purpose for the processing of inventory so that it will become a finished goods. Material, direct overheads, right? So there are direct labor, material, and overheads. In addition to that, there are allocation of fixed and variable production overheads also. Allocation of fixed and variable production overheads. What is my fixed overhead? Factory maintenance, factory rent, depreciation of machinery, right? So these are kind of these are kind of fixed overheads which has to be allocated, right? And what is a variable production overhead? Variable production overhead are those overheads which are directly related to the production of the asset. For example, primary packaging material. If you are manufacturing 1000 quantity of Maggi, you will need 1000 packaging material, right? If you are manufacturing 1000 packets of milk, you need 1000 plastic packets, right? So these are directly related to the manufacturing of inventory per unit. Okay. So variable cost is fixed per unit. Fixed cost is fixed. Fixed cost is fixed in entirety, like factory rent. Doesn't matter. You produce, you will not produce, you will produce 1000 quantity, you will produce 1 lakh quantity, factory rent will be same. But variable rent is per unit fixed. For example, if per unit cost is 2 rupees and you are manufacturing 10,000 quantity, it will be 20,000 rupees. You are manufacturing 1 lakh quantity, it will be 2 lakh rupees, right? So variable production is fixed per unit. Allocation of fixed overheads. How fixed overheads will be allocated? This is an important part. And sometimes students make some error in this kind of concepts. Uppercase is saying fixed cost is variable per unit. Fixed cost, yes, maybe. Okay. And you will get your answer when I'll explain this concept. So fixed cost is allocated on the basis of normal production capacity, right? You guys are into CA final and you must have, you must be aware about the concept of standard costing, budgeting, right? The concept says that the fixed cost, the concept says that there is a normal capacity, right? Budgeted capacity, standard capacity, normal capacity. For example, every plant has a normal capacity. Every plant has a normal capacity, right? Normal capacity is the idle, not idle, the ideal capacity of that plant. Let's say the plant has a normal capacity of 1 lakh unit of output. Okay. And the factory rent is 5 lakh rupees per month. And the normal capacity is 1 lakh per unit of output on a monthly basis. So if I'll produce 1 lakh unit of output, what is my per unit of cost which needs to be allocated? 5 lakh divided by 1 lakh, 5 rupee is my fixed per unit of cost, right? But what happens if my actual production, is equal to normal production, then life is simple. But what happens if my actual production is more than the normal production? मेरा normal production है 5 lakh unit का. This is a standard production. But my actual production is, let's say, 10 lakh. My normal production is 1 lakh unit. My actual production is 2 lakh unit, for example. In that case, what will happen? My cost is 5 lakh rupees, right? All agree my cost is 5 lakh rupees. And my normal production is 1 lakh unit of output. The life is pretty simple. 5 lakh divided by 1 lakh, 5 rupees per unit will be allocated. But my actual production is beyond my normal production and it is 2 lakh unit of output. So if I'll allocate on the basis of normal production here, so amount is 5 rupees per unit of output, but my unit produced is 2 lakh. So if I'll multiply by 5 with this 2 lakh, it will comes out at 10 lakh rupees. Can I allocate 10 lakh rupees as a fixed cost to my inventory? Answer is no, because my fixed cost is 5 lakh rupees only. So friends, if my actual production is equal to normal production, the fixed cost is allocated over a normal production. If my actual production is more than the normal production, then fixed cost has to be allocated on the basis of actual production. 5 lakh divided by 2 lakh unit, it comes out at 2.5 rupees per unit. So that this cost needs to be allocated to every item of inventory, every unit of inventory. And since the total cost is fixed, it cannot go beyond that. And hence we cannot divide this cost on normal production. We have to divide this cost into the actual production. There is an efficiency. But what happens if my actual production is lower than the normal production? In that case, what will happen? My actual production is 50,000 unit. However, my normal production is 1 lakh. If there is an inefficiency, there is an abnormal loss. So what we should do? Standard says that if actual production is less than the normal production, in that case, you have to allocate on the basis of normal production. So going by the normal production, what is my fixed per unit of cost? 5 rupees per unit of cost. 5 lakh divided by 1 lakh, 5 rupees. What is my total unit of output? 50,000. 50,000 multiplied by 5, 2.5 lakh. But my total cost is 5 lakh rupees. So the remaining 2.5 lakh will charge to the P&L immediately as an abnormal loss. Abrakesh, is that clear? Is that clear, Abrakesh? To summarize, your fixed cost needs to be allocated on the basis of normal production, right? If actual production is normal production, then there is no any problem. If actual production is more than the normal production, it has to be allocated over actual production so that cost can be allocated to every unit of output. If actual production is less than the normal production, the fixed cost needs to be allocated on the basis of normal production, right? And the remaining inefficiency will go to the P&L, right? I hope it is clear. Prerna, is that clear? This is one of the examples from study material which I have covered in the last batch. Same example which I have taken, right? So what is not included in the cost of inventory? Abnormal amount of wasted material, labor, or production cost. DLF was constructing a site, was constructing flats, and 1,000 bags of cement was stolen. 1,000 bags of cement. It is an abnormal loss. It is not a part of the cost of inventory. It is not part of the cost of finished goods. It's an abnormal loss. Storage cost, unless those costs are necessary in the production process before a further production stage. Storage cost. For ice cream, right? For perishable item, the refrigeration is mandatory. Okay. So those cost is part of the inventory, because if you will not refrigerate, it is not, the inventory will not come into the sellable condition, right? So storage cost, for example, whiskey, storage cost is mandatory. But otherwise, for example, you have produced extra unit of output and you have stored in the godown or warehouse, right? Or store, the rent of the godown, warehouse, or store is not part of the inventory. It will be part of your P&L account. Administrative overheads. There is a security guard who is watching those inventories. The salary of security guard is not a cost of inventory. It is a P&L item. Selling cost. You are advertising. You have seen that Pepsi, there are a lot of Amul butter, Pepsi, Maggie, right? So a lot of items are there where these actors or actress are doing the brand promotion. Okay. So these advertisement costs are not a cost of inventory. It is a P&L cost. It is expense to P&L. Now, friends, one of the important part in inventory is joint product and byproduct, right? While manufacturing a petrol, you found diesel also. So what is this? This is a joint product because both the products are valuable. The cost of petrol is around 94 rupees and the cost of diesel is also around 84-85 rupees. These are comparatively both are valuable materials, right? So while doing a production process, if some other product also emerge out. It is known as a joint product. In case of a joint product, you are extracting, you are producing, you got two products. How will you do the accounting? How will you allocate the cost? Because when you are digging the mine, you got two minerals, right? And both the minerals have some value and there is a common cost. So how this cost will be allocated? Standard says that if the outcome is joint product and the cost of conversion is separately identifiable, you can identify the cost of petrol, you can identify the cost of diesel, then there is no problem. In that case, you have to allocate, you have to segregate the cost which is related to the particular item. As simple as that. But when the cost of conversion is not separately identifiable, you are doing the processing, you found two material, and the cost of conversion is not separately identifiable. In that case, you have to allocate the cost on the basis of sales value, on the basis of relative sales value. Okay. For example, sales value of A product is 5 lakh. Sales value of B product is also 5 lakh. Then you have to allocate the cost in the ratio 1:1, 50-50, right? So this is how you need to allocate the cost. Sometimes while doing a production process, in addition to joint product, there is a byproduct also, right? So generally byproduct cost is considered as an immaterial. Its value is considered as immaterial. So if the value of the byproduct is immaterial, in that case, that byproduct is measured at net realizable value, and this value is deducted from the cost of the product, right? From the cost of the process. Okay. But what happens if the byproduct is also equally valuable? It is equally material. In that case, that byproduct will be considered as a joint product, right? And again, the cost of conversion, if it is identifiable, the cost of the process, it has to be allocated separately. If it is not identifiable, in that case, it has to be allocated in the ratio of sales value. In petroleum production, crude oil is raw material. How it will be allocated? So, Abrakes, while producing a petroleum, you got a crude oil. That is the cost of raw material, right? That is the cost of raw material. And let's say from the crude oil, two things are emerging: petroleum and diesel, right? This is what you are asking. This is what you are asking, Abrakesh. Let's say while doing the production, the cost of the production is, for example, 50 rupees per barrel. And now two products have been emerged, 1 liter of petrol, 1 liter of diesel. The price of petrol is, for example, 100 rupees. The price of diesel is 80 rupees, the sales value. So this 50 rupee of crude oil has to be allocated in the ratio of 10:8. 50 multiplied by 10 divided by 18, 50 multiplied by 8 divided by 18. This is how this cost needs to be allocated. Hence, there was a illustration. There is an illustration on this joint product and byproduct, which I have covered in the last batch. And this is a very, very, very good illustration, right? Which is important for clarifying the concept. You can solve this illustration from the study material, and probably this concept is clear to you. Cost formula. Friends, we discussed that initially the inventory is measured at cost, right? We understood the various costs, what is included, what is not included. We understood how fixed cost will be allocated, right? We understood the concept of joint product and byproduct. And now what is the cost formulas, right? It is very important that how the cost of inventory has to be measured, right? So friends, if there is a specific identification, right? Goods or services produced and segregated for specific projects shall be using a specific identification for the individual cost. Jewelry, right? Let's say there are 5 jewelry and all the jewelry is having 100 gram 22 karat gold, but the price of every jewelry will be different, right? So the jewelry has a specific identification. Okay. So the manufacturer, the producer, the shopkeeper, they have to specifically identify the jewelry and specifically assign the cost of the jewelry, right? Jewelry cost, if jewelry is an inventory, the cost has to be maintained on an individual item basis. Like, have you heard about Dilip Chabadia, DC, for modified cars, right? What is the difference between DC and what is the difference between Maruti? When you go to the stockyard of Maruti and when you see the Maruti Swift car, every car is similar. Let's say there are 100 white Maruti Swift car, and when you will go to the showroom to purchase one car, they will just pick one car from this 100 car of stockyard, because every car is identical, every car is same, right? But when you go to the showroom of Dilip Chabadia, he is into modified cars. Every car has a separate identification. Every car has a different value, right? Probably 10 Maruti Swift cars will be there in the showroom of Dilip Chabadia also. But the way he has modified the cars, every car looks different, right? So these kind of items are specifically identified and have a individual cost assigned to it. But what happens when there is no specific identification? Like cars in the plant of Tata Motors, in Maruti, these all are identical, right? The Maggie in the plant of Nestle, same. There are 1,000 packets of Maggies, 1,000 bundles of Maggie, right? So everyone is same. You just need to put the hand, pick one packet, same, right? So when there is a no specific identification, in that case, standard says that FIFO or weighted average cost formula. FIFO means first in, first out, first in, first out. Okay. For example, the company is applying FIFO method and the closing inventory is 1,000 unit. Closing inventory is 1,000 unit. The company has purchased almost 20,000 unit during the year. The company has sold 19,000 unit during the year. So what company will do? The company will simple do the maths. Whatever has come first, gone first. So my last consignment, the rate on which I have purchased my last consignment is the rate for this 1,000 unit of inventory, which is my closing stock. For example, the last consignment was purchased at 10 rupees. So 1,000 multiplied by 10, 10,000 is my value of the closing stock. And what is my weighted average cost formula? Weighted average cost formula means whatever price at which I have purchased the different consignment during the year. Total price divided by total purchase, give me the per unit of cost. I'll apply that per unit of cost to this closing stock. It will give me closing inventory value, right? So where specific identification is available, the specific cost is the cost of inventory. Where there is no specific identification, FIFO weighted average formula. Okay. LIFO method is prohibited under accounting standard, under Ind AS, under IFRS. Everywhere LIFO method is prohibited. Okay. And the entity is required to use the same cost formula for all inventory having a similar use to the entity, right? The company is producing FMCG product, right? Like chocolate, jam, sausage, chutneys, soft drinks. For all these items, the company is applying FIFO method, right? FIFO method. Friends, the same company is also selling plastic products. The same company is selling plastic jars, right? Plastic containers. So for FMCG product, the company can apply FIFO method. For plastic jars, the company can apply weighted average method, right? It is allowed. But whatever method you will follow, same method will be consistently followed for similar classes of inventory. Uppercase is saying why LIFO method is prohibited. Uppercase LIFO method is prohibited just to ensure the manipulation should not happen, right? So what is the meaning of LIFO? LIFO means last in, first out. Means the inventory which you have purchased just now, you will sell just now. Will you do that? Tell me. Normally, if you are a manufacturer, you are a shopkeeper, or you are a trader, what is your business interest? Your business interest is to sell the product which you have purchased, earlier, right? So the item which you have purchased, which is old item, you have to sell those items first, because everything has an expiry, right? Everything has an expiry, I would say. So friends, so that company will not be able to manipulate, and hence the LIFO method is prohibited in accounting standard Ind AS and IFRS everywhere, right? For inventory with a different nature or use, different cost formula may be justified, as I told, plastic example and grocery example, FMCG example. As I told you that inventory valuation technique, if inventory is ordinarily changeable means in the stockyard of Maruti, 100 Maruti Swift cars. So you can pick any car, same car, it is there. So if inventory is ordinarily changeable, you can apply historical cost method, which is FIFO or weighted average. Or you can also apply non-historical method. For example, retail sale price method. Like in case of a, grocery store, there are large quantity of multiple items, and it is difficult to identify what is the cost of this chocolate, what is the cost of this Maggie, soft drink, pulses, rice, this, that. So that outlet, or that I would say that super bazaar knows that whatever cost I'll purchase, I'll have a margin of 20%, right? I'll have a margin of 20%. So sale price is known because sale price is there, which has been printed on the wrapper, right? And the shopkeeper knows the sale price, and he knows that whatever amount, whatever price on which I'll sell the inventory, I'll earn 20% margin. So going by the retail sale price method, how he will measure the inventory? The sale price of inventory is 1 lakh, 20% is margin, 80,000 is cost. This is how he will derive the cost. Or a standard cost method, that applying the normal level of material, labor, and cost of production. What is my standard cost, right? This is how the cost needs to be calculated going by the non-historical method. If the inventories are not ordinarily changeable, modified cars, jewelries, right? In that case, the specific identification method needs to be applied for the measurement and calculation of inventory. These are the examples or case studies which I have taken. Net realizable value, friend, one of the important aspect I need to tell you, net realizable value is never a fair value. It is never a market value, right? Normally students, and not only students, the chartered accountants also made error many times, right? And usually they will say cost or NRV, whichever is lower. Instead of saying cost or NRV, whichever is lower, they usually say cost or market value, whichever is lower. NRV is not a market value. NRV is a net realizable value. It's an entity specific value, not a market value, right? And let me give you the difference between NRV and market value. For example, there is a CA firm, there is established, well-renowned CA firm, right? And a client went to that CA firm to get his income tax return filed, right? So that CA firm is a well-known firm, and he asked, sir, what is the fees for filing this income tax return? That chartered accountant says 50,000 rupees. Okay. Then he went to a small CA firm who was a fresher chartered accountant, and he asked what is the fees for filing of this income tax return. He told 5,000 rupees. He told 5,000 rupees. Let's say ICAI has told that the income tax return for such a value, the chartered accountant needs to charge a minimum amount of this much rupees for, let's say, 15,000 rupees. 15,000 rupees, 15,000 rupees. So this 15,000 rupees is a market value. This is considered as a fair value. But 5,000 rupees for a fresher chartered accountant and 50,000 rupees for well-known chartered accountant is considered as an entity specific value. It is considered as a NRV, net realizable value, right? So what is the net realizable value? Net realizable value is the estimated selling price by that company or entity. Estimated selling price. For example, the company expects that I will be able to sell that asset in for 100 rupees. Estimated cost of completion, if it is a work in progress. If it is a finished goods, then there is no estimated cost of completion, right? But let's say if there is a work in progress, and this company knows that I will be able to sell at 100 rupees. My estimated production, my estimated completion cost is 20 rupees, right? And I'll incur a selling cost of 10 rupees. So what is my NRV? My NRV is 70 rupees. But let's say the total cost is 90 rupees. Okay. In this case, cost is 90, NRV is 70. What is lower? NRV is lower. So this inventory has to be measured at NRV. And this 20 rupee will charge to the impairment loss in the P&L because the cost incurred is 90 rupees. The cost of inventory is 90 rupees. Right? So I hope you have understood the concept of NRV. Inventory has to be measured at cost or NRV, whichever is lower. Finished goods and work in progress has to be measured at cost or NRV, whichever is lower. Sir, what about raw material? For raw material, something different is given. Friends, raw material and other supplies, which is held for use in the production of the inventory. Let's say the company is manufacturer of mobile phones. These are the mobile phones and the company is manufacturer of the mobile phones. You remember in mobile phone, one of the important item is screen, right? And I still remember I have purchased a mobile phone which was Samsung S9 Plus. The cost was around 50,000 rupees. And the screen got damaged. And I went to the showroom or service center. And the cost of the screen was 20,000 rupees, which they have charged from me. 20,000 rupees. So the screen is a raw material for that mobile. Right. Now, for example, the company has 5,000 unit of those screen in the factory. It is a closing stock of raw material. Okay. So friends, when the finished goods are sold at or above cost, right? For example, the total cost of the raw material of the finished goods, total of the cost of the raw material is 40,000 rupees. And the mobile phone is getting sold at 40,000 or more than 40,000, then the raw material will always be measured at cost. मतलब अगर फिनिश गुड्स को मैं कॉस्ट या कॉस्ट से ज्यादा पे बेच पा रहा हूं तो मेरा रॉ मटेरियल हमेशा कॉस्ट पे वैल्यू होगा, नॉट कॉस्ट और एनआरवी. बट व्हाट हैपेंस इफ माय फिनिश गुड्स are sold at NRV, which is lower than the cost? If it is sold at NRV, for example, the total cost of raw material is 40,000, right? But my value of finished goods has declined due to the decline in demand. It become 35,000. So if my finished goods is sold at NRV, I mean to say below cost, in that case, raw material is also measured at replacement cost, which is measured at NRV, right? So raw material cost is also measured at NRV, right? So raw material cost is measured at as replacement cost, okay, which is measured at as NRV. Is that clear? Because if the demand of the finished goods will decline, the demand of raw material will also decline, right? So my earlier cost of raw material is, for example, 40,000. But when I go to the market today and I'll buy that raw material, probably I was getting at 30,000 rupees only. So in that case, it will be measured at 30,000 rupees. Write down of inventories and reversals of write downs. Inventories have to be measured at cost or NRV, whichever is lower. Cost is 100 rupees, NRV is 90 rupees. So 10 rupee of write down, 10 rupee of impairment loss is going to be recognized in the P&L. But tomorrow, what happens if the demand of the inventory grow up? In that case, whatever reversals you have made, whatever impairment loss you have charged, you can reverse that impairment loss. Disclosures, not too much important from the examination perspective. From the real life perspective, yes, it may be important. So accounting policy adopted, carrying value of the inventory, right? If there is any write down, which is impairment loss, so these things are required to be disclosed. And this is your favorite slide, which is thank you. I have completed Ind AS 2 inventories in the 50 minutes. And I would say it is not only a revision, it was a complete coverage of the concept of Ind AS 2. Right? If you will read, listen, watched, practice the last batch video, which was covered in almost 3 hours, and then you will just listen this 50 minutes video, probably you will have a good revision on Ind AS 2 inventory standard. Any question, Abrikesh or Prerna? Shruti, any question? Let me check if there is any question on the ICAI query link. Yes, there is one question. For example, the company was having a cost of finished goods at 100 rupees and it become 90 rupees as a NRV, right? So we will recognize at 90 rupees and we will recognize 10 rupees as an impairment loss. She is asking, sir, in the next year, inventory is unsold and now the net realizable value become 110 rupees. Sir, can I reverse the impairment by 20 rupees? I mean to say, can I take it to, can I measure my inventory at 110 rupees now? Answer is no. What is the concept? Cost or NRV, whichever is lower. You cannot take your inventory beyond cost, right? Your cost was 100, NRV was 90. Now NRV become 110. So you can only increase your inventory to the extent of reversal of impairment. Okay, so friends, now I'm sharing the screen for just a minute. I'm sharing my screen. Are you able to see the screen on impairment of asset standard in Ind AS 36? Are you able to see? Okay. Intentionally, I have kept the same dates on which I have taken this standard, right? Intentionally. Hence, what is the concept of impairment, first of all? Right. Impairment is a negative word, and this word is used for the asset. If your liability is impaired, you will celebrate, right? Impairment of liability is a positive word, but impairment does not called out in the context of liability. Impairment always called out in the context of an asset. And what is the meaning of an impairment? I'll discuss with the help of one example, since you guys have already covered Ind AS 16 PP, Ind AS 38 intangible asset, and Ind AS 40 investment property. So everywhere, the concept of impairment was there, everywhere. Now, let me discuss with the help of one example that how impairment is different from depreciation and what actually impairment is. Friends, let's say, Abrikesh, can you just name one of the car? Or Prerna, if you can just take a name of a car. Wagoner. Okay. So Maruti Wagoner car. Company has purchased a Maruti Wagoner car. The price was 6 lakh rupees. The life was 10 years, right? It was a diesel car. What was the price? The price was 6 lakh. The price was 6 lakh. Okay. And life was 10 years. So what is my per annum depreciation? Life was 10 years. What is my per annum depreciation? 60,000 rupees. What is my carrying value in the first year? What is my carrying value in the first year? 5 lakh. How come it is 590? 6 lakh minus 60,000, 5 lakh 40,000. Yes. So 5 lakh 40,000. What is my carrying value in the second year? End of the second year? 540 minus 60, 480. The carrying value of this Maruti Wagoner car is 4 lakh 80,000 at the end of second year. This was a diesel car. The remaining life was 8 years. The car was in good condition, right? The company was happy with the car. So the car was running in Delhi, and the government has come up with an announcement that diesel car will be banned after 6 months. After 6 months, due to the pollution, the diesel car is not allowed to run on the street of Delhi, run on the roads of Delhi. Friends, you were depreciating considering that yes, I'll use this car for 10 years, and I am allocating the cost of the car in terms of a depreciation, which is over a period of 10 years, and end of the 10 years, the value of the car will become zero. Suddenly, when the government has come up with this negative announcement, don't you think that the market value of the car will suddenly go down? Don't you think? When you go to the market, no one wants to purchase that car. You have to sell that car outside of Delhi, and probably the value of this car will go down substantially. So when you are depreciating, you are considering that yes, this will be my approximate to market value. This is the value of my asset, and I am depreciating it consistently, and the carrying value is 4 lakh 80,000. But now the market value has become, you went to, Kirti Nagar market, and you found that the market value becomes 3 lakh only. So the carrying value is 4 lakh 80,000 and the market value is 3 lakhs only. Market value is 3 lakhs. What to do now? What to do? You have to charge the differential 4.8 minus 3. You have to charge 1 lakh 80,000 rupees as an impairment loss. You have to charge 1 lakh 80,000 rupees as an impairment loss. Right? As an impairment loss. So at the end of the second year, the value of this car becomes 3 lakh rupees. From 6 lakh, it will become 3 lakh. 1 lakh 20,000 you have charged as a depreciation, accumulated depreciation is 1 lakh 20, and 1 lakh 80,000 you have charged as an impairment loss. Friends, is there any, due to this announcement, is there any change? Is there any reduction in the efficiency of that car? The car which was running yesterday, it will be running tomorrow also. There is no change in anything relating to the car. But the value has substantially declined due to some additional factors, indicators, right? My recoverable value has been declined. in comparison to my carrying value. And this is how the impairment loss come into the picture. This is how the impairment loss is going to be charged, right? So what is my impairment loss? If I need to summarize, what is my impairment loss and how it is different from depreciation? Since depreciation is a systematic charge, right? On the basis of straight line method, WDV method, or unit of production method. And even the definition of depreciation is a systematic allocation of depreciable amount over the useful life. Depreciation is a systematic charge. But impairment is a one-off event. Impairment is a one-off event. Impairment is one-off event, right? Every time you will not charge impairment. Since this time there was a announcement, there was an indicator, and hence there was an impairment. Depreciation is a consumption based, right? So you are depreciating the asset because you are depreciating the asset on the basis of pattern of future economic benefit. You are consuming the asset, the value of the asset is eroded, you are depreciating over the life. But impairment is event based. The car was, I parked the car yesterday night in my garage. In the paper, the announcement has come, right? And the value of the car has been declined substantially. So it's an event based. Depreciation is a consistent charge, regular expense, but impairment is like one time hit. So this impairment is nothing. It's a extra dent to the P&L over and above. Okay, depreciation. I hope you guys have understood the difference between depreciation and impairment. Hence, in this standard, we will be quickly revising objective, scope, and meaning of impairment loss, identification of an asset that may be impaired. Friends, in this entire standard, the impairment has been bifurcated into two parts. One is individual asset, the second one is cash generating unit, which is known as a group of assets. We will discuss measurement of recoverable amount, how to measure recoverable amount, because in this entire standard, you have to compare your carrying value, which is value in your books of accounts, with the recoverable values. Okay. Then we will discuss how to recognize and how to measure an impairment loss. We will discuss the concept of cash generating unit, concept of goodwill, and concept of corporate assets. We will discuss how the impairment loss will be allocated and in which situation and how the impairment loss will be reversed. And we will also discuss some disclosures relating to the impairment loss. We'll just touch upon. Objective, I told you that every standard is drafted with some objective. And as the name suggests, impairment of assets, this standard talks about the accounting for impairment. When I say accounting for impairment, when an impairment loss is required to be recognized, how is it measured, how is it presented, how is it disclosed? So objective of this standard is to ensure that the assets should not be carried in the balance sheet beyond their recoverable amount, right? So that user will get a good picture. I am a shareholder of a company, and the company has shown the PP at 1,000 crores. The market value of the property is only 600 crores. So I am celebrating after looking at 1,000 crore of number. I'm saying, wow, the company has 1,000 crore of PP. But the reality is the company is only having a PP of 600 crores. Recoverable amount is 600. The carrying value is 1,000. So of course, impairment must be there. And the company has to show this asset not beyond the recoverable amount, means at 600 crores only. How to determine the recoverable amount, how to allocate and reverse impairment loss, and what should be the disclosure. This is the objective of the standard. And this standard is applicable to all the assets, not liabilities, all assets, except negative list is given, except inventory. Sir, it means inventory is not going to be impaired. This standard is not covering inventory. It means inventory will be never impaired. Just 5 minutes before, I have taken inventory standard. Whether inventory can be impaired or cannot be impaired. Inventory can be impaired now as per Ind AS 2. So impairment on inventory will be there, but not as per Ind AS 36. It is as per Ind AS 2. I have said na cost or NRV, whichever is lower. If NRV is lower than cost, that is the impairment na. Right, Prerna? Abrikesh? Impairment on inventory is there, but not as per Ind AS 36, as per Ind AS 2. Contract assets and asset arising from the cost to obtain or fulfill a contract. Contract assets, construction contracts. Whether these are not subject to impairment, these are subject to impairment, but not as per Ind AS 36, as per Ind AS 115. Deferred tax assets. Whether DTA cannot be impaired, it can be impaired, but not as per 36, as per 12. Asset arising from employee benefit, again as per Ind AS 19. So these are some, it applies to all assets except these assets. Biological assets, not as per Ind AS 36, but as per 41. Insurance contract as per Ind AS 104. Non-current asset classified as held for sale as per Ind AS 105. Financial assets, debtors as per Ind AS 109. On these items, Ind AS 36 is not applicable, but otherwise Ind AS 36 is applicable for all assets, for all impairment on assets, right? What is my impairment loss? My impairment loss situation will arise when my carrying value of the asset is higher than the recoverable value of the asset. When my carrying value of the asset is higher than the recoverable value of the asset. Correct, friends? So whenever the carrying amount is higher than the recoverable amount, there is a situation of impairment loss, right? And when I subtract my recoverable amount from carrying value, for example, carrying value is 100 rupees in the balance sheet, in the books of accounts, but the recoverable value is only 80 rupees. So I have to recognize an impairment loss of 20 rupees in the P&L. Correct? Is that right? Okay. Any question? No question so far. Now, what is the meaning of recoverable amount? And this is same which we have read in AS 28 also. The recoverable amount of an asset or group of asset. Group of asset is known as CGU, cash generating unit, CGU. Okay. So friends, the recoverable amount of an asset or a group of asset, which is a cash generating unit, is the higher of fair value less cost to sale and value in use. Is the higher of fair value less cost to sale and value in use. We will discuss it. What is meaning of fair value less cost to sell and what is the meaning of value in use. The carrying value of a building in the books of ABC Limited as on 31st March 16 is 250 lakhs. As on that date, the value in use is 200 lakhs and fair value less cost of disposal is 188 lakhs. Right? Calculate the impairment loss in the books of ABC Limited. So what is the value? What is my fair value? Fair value is 188. What is my value in use? 200. What is my carrying value? 250. In this case, my carrying value is 250, right? My recoverable value, higher of fair value less cost to sell and value in use. Fair value is 188, value in use is 200, recoverable value is 200, right? Which is higher. So 250 minus 200, 50 rupees your impairment loss, right? Any challenge here? Any challenge, friends? 50 rupees is my impairment loss. Have you guys done the revision of Ind AS 36? Have you guys watched the video of Ind AS 36 before? Yes or no? Yes. Okay. Hence, now the question is, you know, the things in the books looks very simple. Simple means you have to assess impairment, you have to book impairment. Is it as simple as that? Practically, answer is no. The impairment is a dent to the P&L, I would say. The impairment is kind of a cost consuming and time consuming exercise. Impairment is a cost consuming and time consuming exercise. If I talk about impairment, and the companies are big companies, they have a big factory, big plants, okay, lot of assets. If they will assess the impairment, if they will check the impairment every year, they will not be able to close their books of accounts easily. Okay. That is why, friends, standard says that before entering into the premise of impairment, whether you will impair, you will not impair, right? Whether you will charge impairment loss or not charge impairment loss, first of all, you need to see whether impairment is required or impairment is not required, right? For example, you have decided that yes, my land and building needs to be impaired, right? You have decided because some indicators are there. Some indicators are saying that the market value of the properties have been declined. There is no buyer in the market. It is substantially declined. There is an indicator. And now, since there is an indicator, now you have to find a value. So how will you find the value? You have to engage the valuer. The valuer will tell you this is the value of your property as on this date. As on this date, right? So when you engage the valuer will charge a valuation cost, valuation fee, right? So without thinking that whether this asset will be impaired or not, every time you will go to the valuer and get the valuation done, it doesn't matter. It will not add any value. It will not add any value. So first of all, standard says that you need to identify whether the asset will be impaired or will not be impaired. How will you identify? I'll tell you. So friends, the standard says that before jumping into the calculation of impairment loss, before getting into the valuation, you need to see, you need to assess whether the impairment will happen or impairment will not happen, right? So an entity shall identify at the end of each reporting period whether there is any indication that the asset may be impaired, whether there is any indication that the asset may be impaired. If there is any indication that the asset may be impaired, there are indicators that the asset may be impaired, then estimate the recoverable amount. Estimate the recoverable amount means go to the valuer, get the valuation done. Means you need to estimate the fair value less cost to sell and value in use. You need to estimate the value in use. So if indicator is not there, you are not required to check the recoverable amount, right? So the first thing is you need to assess at the end of each reporting period on 31st March whether there is any indicator which says that the asset can be impaired. If yes, the indicator is there, you need to estimate your recoverable amount. Is that clear? Is that clear? Sir, what could be the indicator? Can anyone tell me what could be the indicator? Which kind of indicators are there? Have you heard about internal indicator, external indicator? Have you heard about indicator, internal, external? What kind of indicators are there? For example, when I started the session on Ind AS 36, I talked about this car example, political announcement, the government announcement. Yes. So the moment government has announced, nothing was happened in the car, but substantially the market values decline. So indicator was government announcement. And then the company needs to get the valuation done. If nothing was there, the car was running perfectly fine. There is no any requirement to go to the valuer or go to the market for the valuation, right? No, there is no any need for that. But since the indicator was there, and hence the valuation was required. Second, and it was an external indicator. What could be the internal indicator? The internal indicator is, for example, the asset performance has been declined. The performance of the asset have been declined. There was a physical damage. You are right, Prerna. There was a physical damage. Let's say the car was giving a mileage of 15 kilometer per liter. Now the car is only giving a mileage of 8 or 9 liter per 8 or 9 kilometer per liter. So this is kind of an internal indicator which says that probably the value of this asset has gone down, right? There is some problem in the parts of this asset, and now we need to have the valuation done, right? So one is valuation, one is value in use, right? So we will discuss fair value and value in use, both the part we will discuss. Okay. So but the crux of the story is you need to see whether indicator exists, whether impairment is required. If it is required, you need to go for the detailed impairment testing, and you need to get the fair valuation as well as value in use calculations done to check the recoverable amount, right? So friends, as I have told you, you need to check the recoverable amount only when the indicator exists. But there are three assets where the exception is there. There are three assets where the exception is. What are those three assets? What are those three assets? All these three are intangible assets. All these three are intangible assets. Okay. All these three are intangible assets. Which one? Which one? Which one? Intangible asset having indefinite life. Intangible asset having indefinite life. Intangible asset not yet available for use. Goodwill acquired in business combination. And on these three intangible assets, you are not required to see the indicator. At the end of every reporting period, you need to do the impairment testing mandatorily. Means you need to see the fair value less cost to sell and value in use to estimate the recoverable amount for these three assets on a regular basis, right? But for other assets, you need to see the impairment testing. You need to see the impairment indicator. These three are only exceptions. These three are exceptions. And now standard says that these three assets, the impairment testing is mandatory on these three assets at least once in a year. At least once in a year. At least once in a year. Okay. Means, sir, are we required to do the impairment testing for these three assets on 31st March every year? Answer is no. If you want to do the impairment testing of, let's say you have these three assets, for example, three assets, you want to do this impairment testing of this intangible asset with indefinite life in quarter 2, for intangible asset not yet available for use in quarter 3, and goodwill acquired in business combination in quarter 4. It is okay. It is okay. But every year you have to be consistent. Means if in this year you have done this in Q2, Q3, and Q4, in the next year, you again have to do the same asset in the same time frame. So the 12 months window will be there. Almost a year window will be there, right? You cannot say that, okay, let's do one thing. I have done this as impairment assessment on this intangible asset in Q2 in the last year. Now in this year, I'll do in Q1 for all the assets. Answer is no. You have to be consistent. In the second year, you have to use the same time frame for impairment of the asset, for impairment of these assets, right? Is that clear? Is that clear? The frequency and timing of the impairment testing should be consistent on a year-to-year basis, right? Now the third example. Let's say if the intangible asset Having indefinite life, and now you guys have understood the meaning of indefinite life, because in the last class I have covered the revision of Ind AS 38. So for example, the company has purchased the intangible asset in the month January 2024, and the company is closing the books of accounts in March 2024. Whether the impairment testing is required on this intangible asset, the company has purchased just 2 months ago. Yes, it is required. Yes. The impairment testing is mandatory at least in once in a financial year. Doesn't matter when the asset was purchased, right? Impairment testing is required. Friends, first of all, don't get confused with the impairment testing and impairment loss. Impairment testing is an exercise. Impairment loss is a result. Okay. So while doing an impairment exercise, you engage a valuer, you got the market value, you got the fair value, but it doesn't mean that the impairment loss will be there. If the fair value is higher than the carrying value, will whether the impairment loss will be there? Answer is no. Impairment loss will not be there. Sir, in this case, what about next financial year? As for this class, we do testing in Q2. It is not a class, it is an asset. It is an asset. For example, this this was an asset which was in Q2. Okay. So in the next year, it will always be in Q2. But the same another asset of the same class has been purchased on Q4. So the impairment testing was happening in Q4. So for this asset, it will be in Q4. The impairment testing is not by the class of asset, right? The revaluation, accounting policy, these will be by the class of asset. For impairment testing, standard does not say class of asset. Okay. It says individual asset. You are assessing the impairment for individual asset or group of assets. Okay? What is internal indicator? What is external indicator? Is like an indicator of a car, left, right. What is my internal indicator? Evidence of obsolescence or physical damage. Evidence of obsolescence or physical damage is an internal indicator. Right? You have seen that my asset becomes obsolete. Physical damage is there, right? So it is a evidence of, it is an internal indicator. Asset remaining idle. The company is not able to get the full use of the asset. It is an indicator. Discontinuance, disposal or restructuring plans. The company is deciding to relocate, discontinue, restructure. It is an indicator of impairment. Declining asset performance is an indicator of impairment. Significant decline in market value. Now there are external indicators. The market value significantly declined. It is an indicator of impairment. Change in technological, market, economic or legal environment. It is an indicator of impairment. In case of mobile phones, right? You purchase the mobile phone at 1 lakh rupees. And I have seen this practically. My wife has purchased one of the Samsung phone for 70,000 rupees. Right. I still remember, and this is 4 years ago. So the mobile phone at 70,000 rupees she has purchased, and after 1 year, because the moment she purchased a model, in the next 1 year, there were two upgraded model came from the Samsung for that phone. Now what happened? In just 1 year, I was looking at the price in the Flipkart at the time of Diwali sale. And I found that the same phone was available at 32,000 rupees. There is a significant decline in market value, right? Same phone. And for example, the company is depreciating such items at over a period of 3 years. So the carrying value of that phone was 50,000 rupees, around 45 or 50,000 rupees. The market value is 32,000 rupees. Of course, there is an impairment, right? Change in interest rate. If the interest rates are increasing, there is an impairment. Why? Why change in interest rate will impact? Why? Please tell me. Friends, when we will compute the value in use, what we will do? Value in use is nothing. It's a present value of future cash flows. So for example, the market interest rates are increasing. So whatever your cash flows are there, when you will discount your cash flow at a higher rate of interest, your value has gone down. Am I right? If you have to discount 100 rupees, which you will receive after 1 year, discount rate is 10%. What is the value of this 100 rupees today? What is the value of 100 rupees today? 91 rupees. If discount rate become 15%, what is the value of your net present value today? What is the value of present value today? It is around 85 rupees, 86 rupees, right? Low market capitalization. The share price of the company has significantly gone down. It is low market capitalization is again an external indicator for checking the impairment testing, for doing the impairment exercise, right? This is an indicator of impairment. This is an indicator of impairment. So friends, it's 8:27 now. So let's have a 10 minutes break. And after that, I'll discuss more concept on this impairment, right? Let's have a 10 minutes break. Now we'll discuss what is meant by recoverable amount. What is meant by recoverable value? Recoverable amount is higher of an assets or CGU. So as I told you that we have to see impairment either at an asset level or at a group of asset level. I'll discuss the concept of cash generating unit. Now we are discussing the concept of recoverable value, which is a fair value less cost to sell and value in use. The higher number will be your recoverable value. Let's say your carrying value is 100 rupees for a machinery, right? Carrying value. You have got the fair valuation done and the fair value arrive at 110 rupees, right? Will you check the value in use also? If your fair value is 110 rupees, so will you check the fair value in use also? Will you do the value in use calculation? Is it relevant? Is it relevant? Standard says that the recoverable value is higher of fair value less cost to sell and value in use. Since you have computed one of the aspect, which is fair value, and it is already higher than the carrying value. So one thing is very much clear. Doesn't matter. Even though if the value in use is only 10, doesn't matter. The higher will be considered and the fair value is already more than the carrying value. It means there will not be any impairment, right? So there is no requirement of checking another leg, another KPI, another parameter, right? So if one leg is higher than the carrying value, so that another leg is not required to be calculated. But otherwise, let's say if this fair value comes at 90 rupees or 95 rupees, then you are required to check the value in use also. Probably value in use may be higher than the carrying value, right? So recoverable amount has to be compared with the carrying value. And if the recoverable amount is lower than the carrying value, then the impairment loss will be there. And recoverable value is higher of what? Two parameters: fair value less cost to sell and value in use. Sir, what is the difference between the fair value and value in use? Fair value is a market driven value. Value in use is a entity specific value, right? It's the entity specific value. So value in use is, if I talk about difference between fair value and value in use, fair value is a market driven value, value in use is an entity specific value. Fair value is a value which will be arrived when you sell your asset. Means fair value will be arrived considering the disposal of an asset. When you go to the market and sell the asset, you will get a fair value. But value in use will be arrived at what is the value by using the asset. What is the cash flows which you will receive by selling the asset. By using the asset, right? And let me explain the concept of value in use and fair value less cost to sell with the help of this Excel file, which I have already shared, which was already there, in the last batch class. So recoverable value is higher of fair value less cost to sell and value in use. It's a market driven value and it's an entity specific value. In case of fair value, value can be derived from the exit point of view. Exit point of view means from selling the asset. Means if I'm assuming if I'll have to go to the market, I have to sell the asset. What is the price I will receive by selling the asset? Right? Today, I have a building. Okay. So the building is located in, for example, Connaught Place area of New Delhi. And the value of the building in my books of account is 50 crore rupees. Okay. So now I have to check the fair value of this building. I have to go to the valuer and I'll ask valuer, what is the price of my building? What is the market price of my building? What is the market rate of my building? Right. So valuer will say that market price of your building is 70 crore rupees. If you go to the market and sell this building, you will be able to fetch a money of 70 crore rupees. 70 crore is a fair value less cost to sell. What is a value in use? If I'll use this building till the life of this building, what is the cash flows which I will be receiving? What is the cash flow which I will be getting? Let's say The life of the building is 50 years. Okay. So in the next 50 years, if I'll let out this property, I'll get a rental of, let's say, 50 lakh. I'll get a rental of, let's say, 50 lakh rupees every year. So the cash flows which I'm getting during the life and the terminal value which I'm getting after the life. So when I'm discounting the entire cash flow, I'm getting a value in use. I'm getting a present value of future cash flows, right? So fair value, when I'm computing, I'm reducing cost of disposal because it is from exit point of view. But whenever I'm computing value in use, it is nothing. It's a present value of future cash flows. It's a present value of future cash, right? So you have understood the difference between fair value, less cost to sell, and value in use. So these are the two important metric which is required to be calculated for arriving at recoverable value, right? And if one of the metric is higher than the carrying value, then the other metric is not required to be computed. This is what standard talks about, right? So let's move on again on my PowerPoint presentation. So fair value we have discussed. This is a price which would be received by selling an asset into the market, right, within a market participants. And what is my cost of disposal? My cost of disposal is an incremental cost. It's an incremental cost, right? For example, when I go to the market and sell the asset, probably I have to incur some taxes, stamp duty, I have to pay some brokerage commission, some legal charges, right, which is directly related to the sale of the asset. For example, I'm getting a valuation done and I valuation fees to the valuer. In that case, should I treat this valuation fee as an valuation fee as a cost of disposal? Abrakesh, Prerna, Shruti, what's your view? Please write on the chat box. This valuation fees is not incremental cost of disposal. This is not a direct, it's a sunk cost. You're right, Abrakesh, it's a sunk cost, right? So this valuation fees is for taking a decision that what is my value of this building, right? This is not directly related to the cost of disposal. But again, when you will pay the brokerage, when you will pay the stamp duty, when you will pay the legal charges, when you will sell the asset. So these are the examples could be your legal cost, stamp duty, and similar transaction taxes, your cost of removing the asset. When you have to sell your plant, your machineries, you have to dismantle it. Correct? So there is a cost of removal. Okay. Directly incremental cost to bring an asset into condition for its sale. When you have to sell your machinery, few machine requires a special packaging. So a special packaging cost may be there. So these are the incremental cost, which is directly related to the cost of disposal. So you have to deduct this cost of disposal from the fair value. And this is how you will be arriving at, fair value less cost of disposal. So friends, let's quickly do the example. ABC Limited owns a bottling plant located in one of the factory. The professional valuers have estimated that the current market value of plant is 10 lakh rupees. This is the current market value. The valuation fee was rupees 1 lakh. So they have paid a fee to the valuer for rupees 1 lakh. Okay. ABC need to dismantle the plant because it has to sell the plant. So ABC need to dismantle the and deliver it to the buyer. Dismantling cost would be rupees 2 lakh. So there is a dismantling cost to it and it is 2 lakh rupees. A specialized packaging cost would be rupees 1 lakh. And legal fees would be rupees 0.5 lakh. You have to determine the fair value less cost to sale. So the fair value is given, which is 10 lakh rupees. Valuation fee is 1 lakh. Dismantling cost is 2 lakh. Packaging cost is 1 lakh. And legal fee would be 0.2 lakh.
0.5 lakh. Now, what is the fair value less cost to sale? So 10 minus 1 minus 2 minus 0.5 or 10 minus 2 minus 1 minus 0.5. This valuation fee is not a cost of disposal. So this dismantling cost, special packaging cost, and legal fee would be the cost of disposal. And this is what the solution is there. Right? 10 minus 2 minus 1 minus 0.5, 6.5. Prerna, not 7.5, it is 6.5. You have to reduce your dismantling cost, packaging cost, and legal fees. Okay? Because this specialized packaging cost is also required to be taken into consideration. Why? Because you have to see the cost of disposal from the perspective of taking it to the condition of sale, right? Taking it to the condition of the sale. Now, value in use, as I told you, the value in use is present value of future cash flows expected to be derived from an asset or cash generating unit. Again, so the concepts are same for individual asset and for group of assets. The concepts are same for individual asset and group of assets. Okay. So present value of estimated cash flows. Primarily two things are important. Whenever you have to compute value in use, what two things are important? Number one, cash flow. Number two, you have to discount the cash flow. Then you need a discount rate. So estimation of future cash flows and discount rate to be used. Right? So value in use, computing the value in use, you have to estimate the future cash flow of the entity which the entity is expecting from the use of the asset. Expectation about possible variation in the amount or timing of those future cash. Sitting today, the life of, let's say, machinery is 10 years. You are estimating what is my future cash flows over a period of 10 years. You are estimating what could be my possible variation in the amount or timing of the future cash flows. In the amount or timing of the future cash flows, because future is uncertain. You are applying your best judgment. Okay. Then you need to consider the concept of time value of money. You need to consider the concept of time value of money, right? Because let's say the life is 10 years. You are estimating I will receive 1 lakh rupees in the every year for first 5 years. In the last 5 years, I'll only receive 50,000 rupees. So the total is 1 lakh multiplied by 5 plus 50,000 multiplied by 5. The total is 7.5 lakh only. But if you switch, if you just reverse it, and instead of estimating that I am getting 1 lakh in the first 5 years and 50,000 in the next 5 years, you are saying that I am getting 50,000 in the first 5 years and 1 lakh in the last 5 years. Whether your present value will be same or it will be quite different. Whether it will be same or it will be substantially different. It will be substantially different. Why? The total cash flow is still 7.5 lakh. Then why it will be different? Due to time value of money. Due to time value, right? So friends, you have to estimate the cash flows. You have to give weightage to the time value of the money. You have to see, see the possible variations, okay, so that you will be able to get the value in use. While estimating the future cash flows, you have to apply some basis for estimating the future cash flow. There must be reasonable and supportable assumption of management best estimate of the condition of the asset over the remaining useful life of the asset. This is more of a practical part, right? And I still remember, 15 years back when I was auditing one of the listed company, the listed company was doing that impairment assessment. The life of the plant was 20 years. You know what assumptions they have taken? They have taken an assumption that, our cash flows will be steady, means constant. They are saying that whatever cash flow I will earn in the first year, I will earn the same cash flows in the last years also. Then I have asked them that over the 20 years of life, do you think your plant condition will remain same? Yeah. Do you think that you will have the same efficiency which you are getting today? Right. So I've asked some questions, and after that, they have changed their projected cash flows. Right. And friends, just be mindful and meaningful. Whenever you are projecting your future cash flows, there is an element of discount rate to it. There is an element of time value of money to it. Right. So the projection are not like an Excel calculation. The management should have a reasonable and supportable assumption that why management is thinking that they will be able to generate such and such of cash flows. Right. Greater weight should be given to external evidence. Standard is saying that while calculating the future cash flows, you have to give more weightage to the external evidence, right, rather than internal evidence. Most recent financial budget or forecast you are required to use, which have been approved by the management. And that is why the auditors are asking for the approved forecast. Projection should cover a maximum period of 5 years unless a longer period can be justified. Okay? Unless a longer period can be justified. So the maximum period of projection is 5 years. But do you think, for example, if I talk about aviation companies, if I talk about telecom companies, they have a life of tower equivalent to 20 years. The life of optical fiber cable is 20 years, 30 years. The life of plane is 20 years. So do you think while doing an impairment testing, they should also take a life of 5 years? Probably, if the tower company will take a life of 5 years, probably there will be a impairment, but they will use the tower for earning over a life of 20 years. Standard says that normally projection should cover a maximum period of 5 years, but the longer period is also okay if it can be justified. While computing the cash flows, now what you are required to include, the cash flow for the cash flow should be estimated assets in their current condition. Assets in their current condition. If you are thinking that, for example, you are a tour and travel company, you have 1,000 fleet of car, right? And you are thinking that, oh, after 5 years, I will have a driverless car, remote cars, driverless car. I will have a saving of driver salary. Standard says that no. Whatever your asset is into the current condition, you have to estimate your cash flows in that condition only. Okay. You cannot predict what is going to happen in future, and accordingly you will take that. Answer is cash flows should be estimated for asset in their current condition. Cash inflows from the continuing use of asset. You have to take the cash inflow from the continuing use of the asset. You are also required to consider cash outflow. Friends, cash flow. The word is, you're not the cash inflow. The word is cash flows. So you have to take cash inflow. You have to remove cash outflow, right? From the cash outflow from the continuing use of the asset, and any terminal cash flow which is received at the end of the life of the asset, right? So cash inflow minus cash outflow, that is your net cash flow from the continuing use of asset plus terminal cash flow. This will be your total cash flow. And when it is getting discounted, it will give you present value of future cash flows. It will give you value in use. What is not required to be included? Future restructuring cost is not required to be included. Improving or enhancing the asset performance. You are saying that, oh, after 3 years, I will do a major renovation. I will do major restructuring and my asset efficiency will be increased. Answer is no. You cannot take that. Cash inflow or outflow in financing activity. You are saying that I'll raise an IPO. So you cannot take that cash inflow or outflow for financing activity. Income tax receipt or payment is not allowed to be taken for cash. Discount rate. Discount rate should always be a pre-tax rate, and the discount rate is related to the time value of money, and risk is specific to that. Hence, practically, your discount rate should be the weighted average cost of capital of the company. You understood the weighted average cost of capital. Probably you have understood this concept in your financial management. If the weighted average cost of capital is not there, you can use the incremental borrowing rate. If it is not there, you can use the other market rate of borrowing. Okay. The next concept, friends, value in use, foreign currency future cash flows. Let's say I'm an Indian company, right? I'm having a property in or a business in USA. I'm having a property in US. So that property was purchased at a that property was purchased in foreign currency. The rental income I am earning in foreign currency, right? The cash flows in foreign currency. I am doing the impairment testing of that foreign currency building, right? So friends, if there is a cash flows in foreign currency, standard says that first of all, you have to estimate future cash flows in the currency in which they will be generated. Number one, you have to estimate cash flows in foreign currency only. So estimated cash flow in foreign currency. As simple as that. Then you have to apply the discount rate applicable to that currency. You have to apply the discount rate applicable to that currency. Do you think that discount rate applicable to India and discount rate applicable to USA is same? What is the discount rate? It is coming from interest rate. Answer is no. In Europe, the people are not happy with the salary. The people doesn't bother about the salary increments. They are only bother about the bonuses. Why? The inflation is not there. Hardly 1 or 2% inflation is there, right? So they don't have any increase in the salary. 1%, 2%, not much. But they are happy with the bonuses. So in India, inflation is there 7 to 8%. When you go and take a loan, it will be at 9%, 10%, right? But when you will go and take a loan in Dubai or USA, you will get a loan at a cheaper rate of interest, which is 3% or 4%, right? So the discount rate is different. So first, estimate the cash flow in foreign currency, estimate the discount rate applicable to that foreign jurisdiction, foreign country, and then whatever present value you will arrive in foreign currency, multiply the exchange rate using the spot rate from US to INR, right? Should apply the spot rate. It will give you the value in use in the domestic currency, into the functional currency, into INR. Okay. So this is how this foreign currency, in case of foreign currency cash flow, the value in use will be calculated. And I've discussed this case study in my last batch. Correct? You can just solve this case study. This is a detailed case study I have covered in my last batch for calculating the impairment loss. Impairment loss measurement we have discussed. When the carrying amount is less than the recoverable amount, carrying amount is more than the recoverable amount, means carrying amount is higher, recoverable amount is lower, then there is a situation of impairment loss. Key points. Impairment loss should be recognized immediately in profit or loss unless the asset is carried at a revalued amount, means PP, intangible asset. The company has opted for a revaluation model, right? And the company was having some revaluation surplus in the other comprehensive income. So now there is an impairment on this PP or intangible asset. Standard says that in that case, the impairment loss has to be adjusted with the revaluation surplus. Right? This is what standard is talking about. Correct, friends? Any challenge? Impairment loss of a revalued asset should be treated as a revaluation decrease. Means it has to be adjusted from revaluation surplus. Your prospective depreciation will also change. Like you remember in that Wagon car example, the purchase price was 6 lakh. At the end of the 2 year, the WDV was carrying value was 480, impairment loss was 180, 3 lakh was the value after impairment, and the remaining life was 8 years. So 3 lakh has to be depreciated in future over the remaining life. Deferred tax asset or deferred tax liability has to be measured, has to be taken on the basis of revised carrying value of the in case of impairment. In case of impairment, the DTA has to be computed on the basis of revised carrying value. Okay. So friends, any challenge so far? Abrikesh, Prerna, Shruti, anyone who is finding any challenge? Harsh is asking, sir, why valuation fee not considered? Harsh, I have explained that valuation fee is not considered because it is not a cost of disposal. When you have to dispose the asset, sell the asset, what is the cost which is there? Right. Tell me, after getting the valuation, if you got the valuation, is it mandatory to sell the asset? Is it mandatory to sell the asset? You can take a decision. No, I don't want to sell the asset. You can take a decision. Right? If the value is not good, probably you will say, I'll wait for more time. I need more time. Right? So this is for the decision taking. This is for the decision making. But when you will pay the brokerage, when you will pay the stamp duty, when will you incur the dismantling cost, when you will incur the packaging cost, when you will incur the transportation cost, when you are actually disposing of the asset, right? So we have discussed the concept of individual asset. Now we have reached to the concept of group of asset, cash generating unit. And what is a cash generating unit? And it says that please determine the recoverable value for the individual asset. But if it is not possible to estimate the recoverable amount of the individual asset, then you can club the assets and make it a group and then compute the recoverable amount. It is known as a cash generating unit. And what is a cash generating unit? It is a smallest identifiable group of asset. It is a smallest identifiable group of asset which can generate cash flow independently. Which can generate cash flow independently. Right? Friends, for example, in case of automobile industry, there is an assembly line. There is an assembly line. And in the assembly line, there are multiple machinery. Machine number 1, 2, 3, 4, 5, 6. The raw material started getting here, right? And the car, the manufactured car, comes from here, right? This is an assembly line. Now, friends, can the recoverable value of this particular asset can be computed in isolation? If these two machineries would not be there in assembly line, can this car will be manufactured? Can this car will be manufactured? No, because every asset has a role to play. For example, this machinery is used for painting. This machinery is used for paint. This machinery is used for installing the engine. This machinery is used for the entire tuning and wiring of this car, right? So every machine has a role, and by getting the help of that particular machinery, all these machineries are running in a chain, right? And when it is passing through this, and this machinery, then only the car will be ready for available for sale. So friends, although you can sell these machineries on a standalone basis, you can sell, but can you compute the value in use for these machineries on a standalone basis? Can you compute the value in use? What is value in use? Your present value of future cash flows by using the asset, right? But there is no individual asset who is generating the cash flows. The entire group of assets are generating the cash flow. This assembly line is the smallest identifiable group of asset which is generated. Needs to be assessed. For example, this assembly line will manufacture, let's say, 500 cars in a year. So what is my cash flow for 500 car? What is inflow? What is outflow for my 500 cars? And that will be the cash flow. And for example, life is 10 years. So I will estimate my future cash flows. I will discount it, and then I'll compute the present value, right? This is how I'll present the I'll compute the present value, right? So one of the example we did for this cash generating unit, a bus company provides services under contract with a municipality that requires minimum service on each of 7 separate routes. Assets devoted to each route and the cash flow from each route can be identified separately. One of the route operates at a significant loss. Should the company determine the recoverable amount for an individual asset or a cash generating unit? There is a bus company, tour and travel company, and this company has 7 buses. It went to the municipality. It went to the municipality and it says that, sir, I need a license or permission to run my buses on the street of Delhi, on the roads of Delhi. The municipality told, okay, I can give you permit, but you have to operate in 7 routes. You have to operate in 7 routes, right? So the buses are separate for each route. Separate hongi na bus. The drivers are separate. One driver cannot drive 7 buses at the same time. So the driver is separate. The bus is separate. The depreciation is separate on the bus. The passengers are separate. The revenue collection is separate. Cost is separate. Petrol is separate, right? Everything is separate on each route. But can you compute the recoverable value of each routes separately? Whether each route independently generating cash flows, yes or no? Yes or no? Uppercase is saying yes. So uppercase, you are looking at form. You are not looking at a substance. You are not looking at a substance. So this municipality has given the permit of operating on these 7 routes, right? Okay. On these 7 routes. And one of the route is at significant losses. This route is at significant losses. This route is at significant losses. Can the company deny to operate, since this is at significant losses? The impairment indicator is there. But can the bus company deny the operation on this route? And probably if the bus company will deny operating in this route, the municipality will not allow operating in these 6 profitable routes, right? So this one loss-making route is providing 6 profitable routes. It means it has to see from the entire bus company as a whole, collectively, right? These 7 routes, these 7 buses as a whole needs to be seen from the smallest group of identifiable assets which are generating independent cash flows, right? So identifying the cash generating unit, it's a theoretical aspect. You need to see it must be having a ability to generate independent cash flows from other assets, right? And how management is taking a decision about its operation. It is again an important factor to identify the cash generating unit. Sometimes the company is making a cash generating unit by reasons. My Delhi plant is one of the cash generating unit. My Jabalpur plant is the another cash generating unit. Sometimes the company is looking from the reason perspective. Sometimes the company is using from the product perspective. The company has a plant, and in that plant there are 3 different products. So machinery is using in product number 1 is one CGU, product number 2 is another CGU. This is how this is there. So cash generating unit should be consistent from one period to another. Goodwill. Goodwill needs to be allocated if there is a goodwill. For example, the company has acquired a business. The company has done the business acquisition, business combination. There is a goodwill to that, right? Standard says that the goodwill needs to be allocated to each cash generating unit, right? Each cash generating unit. But which cash generating unit? Where the cash generating unit are getting benefited from that acquisition, right? For example, goodwill is 100 rupees and there are 10 cash generating unit, and all the cash generating unit are benefited from this business acquisition. So this goodwill needs to be allocated to all these cash generating units, right? Critical aspect, but again, from the standard perspective, you need to understand that this goodwill amount also needs to be allocated to the cash generating unit. So in your examination, for example, the goodwill is given, the 4 cash generating unit is also given, and it is written that the goodwill, from the business combination, from where this goodwill is arised, the company is getting benefited for 3 cash generating units, 1, 2, 3, and there is no benefit to CGU number 4. In that case, you are not required to allocate the goodwill to CGU 4, and you are required to allocate the goodwill only to CGU 1, 2, and 3. Right? Impairment testing frequency and timing. Friends, standard says that if you have a cash generating unit with, remember, 3 assets, with intangible asset not yet available for use, intangible asset with limited life, or goodwill acquired in business combination. If you have any of these 3 assets in your CGU, you have to test for impairment whenever there is an indicator, right? Whenever there is an indicator, you have to check the impairment. But even though if there is no indicator, in that case, at least once in a year, you have to test the impairment. You have to do the impairment testing once in a year. Sir, what does it mean? So moral of the story is, if you have a group of asset, cash generating unit with any of these 3 items, right? Doesn't matter whether indicator is there, indicator is not there, doesn't matter. You have to do the impairment testing at least once in a year. But during the year, you have more indicator of impairment. For example, you have done the impairment testing in Q1, in first quarter. You are a listed company and you are publishing the result for quarter number 2. So while publishing the result of Q2, you found that there is an indicator of impairment. In that case, you have to again do that impairment exercise. So friends, whenever this goodwill, intangible asset, indefinite life asset is there, the minimum requirement is once in a year, but the maximum impairment testing may be there depending on the indicator. Correct? So these concepts are impairment because when standard, when in your examination question, it will say that the company has a goodwill arising in business combination, right? And in multiple choice question, it was asked whether this goodwill need to be tested for impairment as there is no indication of impairment. You have to say yes. Why? Because for this asset, doesn't matter indicator is there or not, you have to do the impairment testing minimum once in a year. At the same time, question will say that although the company has already done the impairment in the second quarter, right? And the company feels that there is no requirement of checking the impairment testing in Q3 and Q4, while the company has a huge losses in Q3 and Q4. So this is kind of an indication the standard is giving you. In that case, my dear friends, doesn't matter that you have already checked the impairment in Q2. You have to again do the impairment testing in Q3 and Q4, considering the indicators are now there, right? What happens if the asset or cash generating unit does not have these three elements: goodwill, intangible asset with indefinite life and not yet available for use? If there is an indication of impairment, test for impairment. If there is no indication of impairment, no impairment testing. It is applicable only when these three items will not be there in the group of assets. Is that clear? This is what I have already covered. Before that, let me discuss the allocation of impairment loss on a cash generating unit. I hope my Excel file is visible to all of you. Is that visible? Allocation of impairment loss to the cash generating unit. Friends, if I talk about allocation of impairment loss on cash generating unit, since you have a carrying value of the assets, it has become a group of assets, right? Now you have a single recoverable value for the cash generating unit, which is a group of asset. Now you are comparing your carrying value of group of asset with recoverable value of group of asset, and there is an impairment loss. So how will you allocate this impairment loss in the multiple assets consisting a group of asset? Standard says that in case there is an impairment loss on cash generating unit, first adjust the goodwill to the extent of impairment loss. Then adjust the other asset in proportion to their carrying value. For example, the company has a goodwill of 20 lakhs, building 30 lakhs, machinery 20 lakhs, software 20 lakhs. The total carrying value is 90 lakhs. The recoverable value of the cash generating unit is 60 lakhs. Compute impairment loss on cash generating unit and show how to calculate the impairment loss on multiple asset of this group and the revised carrying value after impairment. My carrying value is 90 lakh, my recoverable value is 60 lakh, my impairment loss is 30 lakhs. I need to allocate this impairment loss of 30 lakhs into these group of assets. Number one, what will I do? First of all, I will hit the entire goodwill. It will become zero. Out of 30, I have given a hit of rupees 20 to the goodwill. I have made the goodwill zero. The remaining 10, I will allocate proportionately in the value of this asset. What is the total value of the asset? Remaining asset 70. So minus 10 multiplied by 30 divided by 70. Right? This is how this value will be there. The total comes out at 30 and the revised carrying value is 1770. Any question here? Any question so far? Any question? Yeah. Now I'm extending this example. Same example. The recoverable value is 60 million. Same example. But the recoverable value of the individual item is also given, one of the item, building. So friends, the recoverable value of building is 32 million. And what is the carrying value of building? The carrying value of building is 30 million. So first of all, my impairment loss is 30 million. I have to allocate this 30 million to these assets. Straight away, I will write off the goodwill. Goodwill will write off. The remaining, whether I will allocate this remaining thing to the building also, allocate any impairment loss to the building. Standard says that in a group of assets, in a cash generating unit, if you have a recoverable value of one of the asset in the group of assets, right? And that recoverable value is more than the carrying value, you cannot allocate the impairment loss. You cannot reduce it, the value of that particular asset, right, below its carrying value. So there will no any impairment on this building. Building will be 30. That remaining has to be allocated pro rata between the remaining assets. Minus 10 multiply by 20 divided by 40. Minus 10 multiply by 20 divided by 40. This is how this impairment loss is going to be allocated. Third case. The recoverable value of cash generating unit is 60 million. The carrying value is 90 million. 30 million is impairment loss. The recoverable value of building is 28 million. It is given at 28 million. Right? Now what happens? Again, I will allocate the impairment loss. Out of 30, entire 20 will be here. Now 10, I will allocate on the remaining asset on a pro rata basis. Minus 10 multiply by 30 divide by 70. It comes out at 4. Should I allocate 4 lakh rupee of impairment loss? Answer is no. Standard says that the allocation of impairment loss should not be more than its individual impairment loss. And individual impairment loss should be 2 only. Because standard says that, the question says that the recoverable value of building is 28 million. Correct? Right? Now what is my remaining impairment loss? 8 million. Remaining minus 8 multiplied by 20 divided by 40. Minus 8 multiplied by 20 divided by 40. This is how the impairment loss is going to be allocated. Right? This is the allocation of impairment loss. Now, let's discuss the concept of corporate assets. What is a corporate asset? Corporate assets are other than goodwill, which contribute to the future cash flows of both the CGU under review and other CGU. So what is a corporate asset? Corporate asset are those assets which are used for the administrative purposes. Office building. Whether office building is generating any cash flows. Factory building. Whether factory building is generating any cash flows. Tell me yes or no. Factory building is generating cash flows, but office building is not generating cash flows. In the factory building, the production is going on, right? And there should be cash flows. But in office building, the admin work is going on. The finance department is putting the accounting entry, preparing MIS, sitting in cubicles, right? So it is more like an administrative office, corporate office. So since the corporate assets cannot be, but the office building can be impaired, but these corporate offices, recoverable value cannot be allocated, recoverable value cannot be calculated. Recoverable value cannot be calculated, right? So in that case, standard says that since the recoverable amount of an individual corporate asset cannot be determined, Standard says that recoverable amount is determined for the cash generating unit to which the corporate asset belongs and is compared with the carrying amount of the CGU. So this corporate asset needs to be attached with one of the CGU, and then impairment assessment is required to be done, right? And how this corporate asset impairment assessment is required to be done, let me discuss that. This part we have already discussed. Yes. So friends, I will discuss the allocation of impairment loss to the corporate asset with the help of this example. Okay. Just allow me a minute. Yeah. Earth Infra Limited has two cash generating unit A and B. There is no goodwill within the unit's carrying values. No goodwill. The carrying value of CGU A for 20 million and CGU B for 30 million. So carrying value is given for CGU A and CGU B. Okay. 20 million and 30 million. The company has an office building which it is using an office headquarter and has not been included in the above values and can be allocated to the units on the basis of their carrying values. So far, I got three information only. I got the carrying value of A and B, which is 20 million, 30 million. I got the carrying value of office building, right, which is 10 million. And this office building is a head office, and hence it is a corporate asset. And this needs to be allocated to the CGU A and B in the ratio of their carrying value, which is 2:3. Okay. This 10 needs to be allocated in the ratio of 2:3. The recoverable amount are based on value in use of 18 million for CGU A and 38 million for CGU B. Recoverable amount is also given 18 for CGU A and 38 for CGU B. Determine whether the carrying value of CGU A and B are impaired. Right? Whether question is clear in the question, 4 information is given. Number 1, carrying value of CGU A and B are given. Number 2, corporate asset carrying value is given. Number 3, it has said that the corporate office value is allocated in the ratio of the carrying value of CGU A and B. Number 4, the recoverable value is also given for both the cash generating units. These are the 4 information given in this question. And the ask of the question is whether the carrying value of CGU A and B are impaired, right? So friends, I'll give you some steps. Okay. First of all, for computing the impairment loss on corporate asset, you need to process some steps. Step number 1, allocate corporate asset in the ratio of cash generating unit, right? What is my cash generating unit values? 20, 30 A and B. The total is 50. And my total corporate asset value is 10. I have allocated in the ratio of 20:30, right? I have allocated in the ratio of 20:30. Okay. 20:30. So 10 multiplied by 20 divided by 50. 10 multiplied by 30 divided by 50. 4 and 6. Step number 1, allocate impairment loss. Allocate the value of the corporate asset in the ratio of cash generating unit. Right? Step number 2, calculate carrying value of cash generating unit after including corporate asset. What is my carrying value of step number 2? This was my step number 1. This is my step number 2. Calculate carrying value after including value of corporate assets. So it is 24, it is 36, the total is 60. Right? This is my step number 2. Step number 3, compare the total carrying value with the recoverable value. What is my recoverable value? Step number 3. I am comparing my carrying value with recoverable value. This is 18 and 38, which is given in the question. The total is 56. So if I compare my carrying value of CGU after corporate asset with recoverable value, 6 is my impairment loss. But in CGUB, the carrying value is 36, the recoverable value is 38, there is no impairment loss. So there is an impairment loss only on CGU, not on CGUD. So step number 4, calculate impairment loss if any. This is my step number 4. I have calculated my impairment loss, right? Now step number 5, and it is the last step. Allocate impairment loss in CGU and corporate asset in ratio of carrying value. First, you have allocated the value of corporate asset in the ratio of the carrying value of CGU. Number 2, you have arrived at the gross carrying value of CGU including corporate asset. Number 3, you have arrived at recoverable value. Number 4, you have arrived at an impairment loss. Number 5, now wherever impairment loss is there, you need to allocate that impairment loss in the ratio of CGU other than corporate asset and the corporate asset. Now, what is the ratio? 20 million is the value of the CGU, 4 million is the value of the corporate asset in this case. So 6 million is the total impairment loss. 6 multiplied by 20 divided by 24. It gives you the impairment loss allocation on CGU. 6 multiplied by 4 divided by 24. It will give you the impairment loss on corporate asset. 1 million is the impairment loss on corporate asset. 5 million is the impairment loss on other assets on this 20 million, right? So what is the carrying value after all this impairment loss? The carrying value of CGU A will be 15 million. The carrying value of the corporate asset is 9 million because this becomes 3 plus 6, 9. So 15 million is the carrying value of CGU A. 30 million is the carrying value of the CGU B, right? And 9 million is the carrying value of corporate asset after impairment. Correct? Is that correct? So out of 60, you got the value which is 30 plus 15, 45 plus 9, 54, because 6 million is the impair. Is that clear, friends? Clear or clear? Although it is a query session, but I'm revising the entire concept just like I'm teaching for the first time. Of course, I cannot take all the case studies and examples from study material because this standard was taught in 6 hours. And now I am getting it covered in 1.5 hours. But I'm covering all the important concepts with the help of examples. Reversal of impairment loss, sir. Can the impairment loss can be reversed? Yes, impairment loss can be reversed if there are favorable indicators. And these are external and internal indicator. And these favorable indicators are just reverse whatever we have discussed, right? Like we have discussed, interest rate has been increased. Now it is interest rate has been decreased. Market value was declined. Now market value has increased, right? The asset was remaining idle. Now the economic performance of the asset is better. So if the favorable indicator is there, you can check again the fair value and that you can check the recoverable value and you can reverse the impairment only to the extent of earlier impairment loss, not beyond that. Sir, if there is an impairment on goodwill, can that be reversed? Answer is now, friends. What could be the extent of reversal of impairment loss? This is important. This is it. Reversal of an impairment loss shall not exceed the carrying value that would have been determined had no impairment loss been recognized for the asset in prior years. What does it mean? So let me explain with the help of an example. I hope my Excel file is visible. Year 1, 3, 4, original value. ₹1 lakh is the original value. This will be 1 lakh only. Original value will always be 1 lakh. Life is 5 years. Depreciation, carrying value. This divide by 5. 20,000. What is my carrying value? This one. Again, the depreciation is there. This minus this. 50,000 is the carrying value at the end of the second year. There was an impairment loss. Impairment in the second year. And this impairment was to the extent of 30,000. Revised carrying value 30,000. Right? So now this 30,000 needs to be depreciated over the period of next 3 years. So what will be my depreciation? Divided by 3. Right? My closing WDV carrying value is this one, then this much, then this much. Okay. This will become 0. Now, for example, in the year 4, in the year 4, in the year 4, the remaining value of the asset becomes 30,000. So there is a favorable indicator. There is a favorable indicator at the end of year 4. And the recoverable value is 40,000. Right? I'm just copying it. Let me take it here. So standard says that now what is my carrying value at the end of year 4? Actual carrying value. What is my recoverable value? What is my recoverable value? 40,000. 40,000. Right? I cannot go beyond. I cannot go beyond 40,000. I cannot go. So 10,000 is my existing carrying value. 40,000 is recoverable value. Can I reverse an impairment loss of 30,000? Can I reverse the impairment loss of 30,000? Answer is no. Standard says that first you need to compute what would have been the carrying value if this asset had never been impaired. If this asset had never been impaired, then what should have been my carrying value? What should have been my carrying value? My carrying value should be 3,000. This is my carrying value, right? But what is my carrying value actually at the end of the fourth year? What is my carrying value? It is 10,000. It is 10,000, right? I would never done the impairment. It should be 20,000. Standard says that recoverable value is more than your carrying value. You can reverse the impairment loss only to the extent of the carrying value which would had been there had the asset never been impaired. अगर एसेट कभी इंपेयर नहीं होता तो कितनी कैरिंग वैल्यू होती, उस एक्सटेंट तक आप इंपेयरमेंट को रिवर्स कर सकते हैं. Why standard has given this restriction? Because you have done the impairment in the second year. Now it is year number 4. You have used this asset. There was a depreciation element, right? If this impairment would never been there, and this impairment is never been there, so of course your WDV is 20,000, not 40,000. And this is how the standard has given a conservatively restriction. that you cannot go beyond what would have been your carrying value going by the original amount, right? So standard says that, friend, I hope it is clear now. Standard says that you cannot reverse your impairment loss to the extent of to beyond the carrying amount which would have been determined had no impairment loss been recognized for the asset in prior years. Reversal of an impairment loss for an asset other than goodwill shall be recognized immediately in P&L. On goodwill, impairment loss can never be reversed. Right? In IGAP, it can be reversed. In Ind AS, it can never be reversed. And reversal of an impairment loss should be taken to P&L. Right? Except. What is that except? Except. If there is a reversal of an impairment loss, right, on a revalued asset, the company was having a PP and the company was applying for revaluation model. In that case, this reversal of impairment loss will be treated as a revaluation increase. You have to see whether you have to take it to the P&L or you have to take it to the revaluation surplus. Right? Depreciation will be charged on the revised carrying value. It has to be charged on the revised carrying value. Okay. So, Abrikes, what is the balance 10,000 impairment loss? It has already been consumed in the form of depreciation. It will not be reversed. So in the year 2, you have debited your P&L by 30,000 rupees, right? And now in the year 4, you will credit your P&L only by 10,000 rupees, not 20,000, 10,000 rupees. My existing carrying value is 10,000. My revised carrying value is 20,000. So I'm only taking a reversal of 10,000, right? So there was a hit of 20,000. Impairment loss on goodwill should never be reversed, right? The reversal of an impairment loss for a cash generating unit should be allocated to the remaining asset of the unit except goodwill. For example, there is a reversal of impairment loss on a cash generating unit. So whatever loss you have allocated to goodwill, it will never be reinstated. But other than that, it can be reversed to the other assets. So this is the reversal of impairment loss example which we have discussed in detail. Right? The figures are there, friends. So not relevant from the examination perspective. The difference between AS28 and Ind AS 36. AS28 covers more assets for impairment testing. Like it includes investments, it includes investments, but AS28 does not include investments. AS28 is silent about biological asset, but Ind AS 36 specifically excludes the biological assets. Okay. Goodwill. So Ind AS 36 says that goodwill has to be allocated to only those cash generating units which are getting benefited from the acquisition. But accounting standard says that goodwill is tested for impairment using bottom up or top down approach. There is no such bottom up or top down approach in Ind AS 36. Reversal of impairment loss for goodwill, it is allowed in AS, but it is not allowed. It is prohibited in Ind AS 36. Right? Mandatory annual impairment testing for goodwill, intangible asset having indefinite life and intangible asset not yet available for use. In Ind AS, there is a mandatory impairment testing, but in accounting standard, there is no mandatory impairment testing. Right? There is no mandatory annual impairment testing in accounting standard. This is a big standard, and that is why I have also given you lesson summary. We discussed the objective and scope of Ind AS 36. We discussed when an asset may be impaired. So an asset may be impaired whenever there is a indication of impairment except 3 assets, which is intangible asset, having indefinite life, not yet available for use, and goodwill. We discussed the concept of recoverable amount, value less cost to sell, and value in use. We discussed how to recognize an impairment loss. The impairment loss has to be debited to the P&L, but if it is on the asset which is opted a revaluation model, for example, PP or intangible asset, it has to be considered as a revaluation decrease. We discuss how to measure an impairment loss. We discuss the concept of cash generating unit. It is the smallest identifiable group of assets which can generate independent cash flow. We discussed allocation of impairment loss on a cash generating unit. First, you need to adjust goodwill. Then you need to adjust the impairment loss, remaining impairment loss to the carrying value of the asset on a pro rata basis. If an asset has a particular or individual recoverable value, you cannot allocate impairment loss beyond its own recoverable value. Then we discuss reversal of impairment loss. You have to reverse your impairment loss to the extent if the impairment loss was never been there, what would have been the carrying value? So that carrying value to that extent you can reverse your impairment loss. Right? Then we discuss the disclosure requirement. So friends, it's 9:50 now, and as per the schedule, I was about to cover three standards: Ind AS 2, 23, and 36. This Ind AS 36 was important to discuss. Ind AS 36 was important to discuss, and I thought to discuss this in detail. Friends, the next class is my class only, and in the next class, I will be discussing Ind AS 23 because in the next class, two small standards are there. Okay. So today I'm not taking the revision of Ind AS 36. I have already covered Ind AS 2 and Ind AS 36. I'm not taking the revision of Ind AS 23. This will be covered in the next class. Let me know if you have any question. So, Ashok ji, can you please unmute Abrikesh?
Good morning, sir.
Good morning, Abrikesh. How are you?
Bas fine, sir. My question is again same to which I asked in the chat box regarding the illustration you have given that intangible asset purchase in January of financial year, particular financial year. So we need to test the impairment testing in that year only for the first time. Now my question is, sir, if that particular intangible asset is a part of any CGU for which we do the testing of impairment once in a year in, for say, for example, quarter 4. So what will be, I mean, the situation for that particular asset bought in, intangible asset bought in Q4 January?
Yes. So first of all, Abrikesh, when you talk about, CGU, when you talk about group of asset, then the concept of individual asset does not become relevant, right? First of all, let's say you have a cash generating unit, which is including your 3-4 intangible assets, right?
Yes.
And those intangible assets are intangible asset not yet available for use or intangible asset having indefinite life, right? Because for these two intangible assets, and of course, goodwill is also there.
Yes.
For these assets, there is a mandatory impairment testing at least once in a year, and consistency needs to be followed.
True.
Right? So since these individual assets does not adding any value, the recoverable value is not determined at individual level. And that is why these assets are clubbed to a smallest identifiable group of assets to make it a group of assets, right? So
Yes.
first of all, the individual criteria which I have told you, for example, if a particular intangible asset has been assessed for impairment in quarter 2, it has to be in quarter 2 in the next year. If it is an individual asset, right? If an asset has been purchased in quarter 4, that particular asset has to be tested for impairment in quarter 4 in this year and next year. Whenever it will become part of the group, it will lose its own identity for the purpose of this impairment consistency, right? In that case, you have to see the cash generating unit. You have to see the cash generating unit, that the CGU in which these kind of assets are there. When you have done the impairment testing of that CGU, for example, you have done in Q3 for this CGU, for example.
Okay.
So now in this year, you have to do in Q3 only. So you have to see from cash generating unit perspective for the of frequency.
Okay. Thank you, sir.
Any other question? Yes, one question is there, and Shruti is asking on the chat box, not on the chat box, on the query box. Sir, if we are reversing an impairment loss, right? So we understood that we have to reverse to the extent what would be my revised carrying value if I have never done the impairment, right? Like in my example, Shruti. So let me again open my Excel file. In my example, my actual carrying value was 10,000. I have never done the impairment. My revised carrying value would be 20,000. How much impairment loss I can reverse? 20 minus 10. 20 minus 10. I can reverse. I can reverse this impairment loss in year 4, right? And Shruti is asking, sir, where this impairment loss reversal will go? Let me tell you the accounting entry. So, asset account debit, because asset value will be increased, account debit by 10,000 to impairment loss reversal in P&L. It has to be P&L credit. But if the company has opted for revaluation model, in that case, you have to see that whether it will be revaluation increase or it will go to the P&L. You have to see accordingly, applying the principle of Ind AS 16 and Ind AS 38, right? Any other question, friends? Let me know if you have any question. Yes, Abrikesh, please ask.
Sir, earlier example you given for reversal of impairment loss. Now there, it has been mentioned that while reversing the loss, we should think that it must not exceed the original carrying value had no impairment loss has been there. Now in the given illustration, the 10,000 rupees carrying value shown in the Excel file in first part is after impairment loss. So it will be 10,000 or 20,000 because original.
So Abrikesh, I understood what you were saying. The 10,000 is the impairment loss, and this is the situation, right? This is
Yes,
the
sir.
original situation now. Because in the second year already an impairment has happened, correct?
Yes,
And in
that's
year
true.
four, what is the carrying value in the books of accounts? 10,000?
10,000. Yes.
10,000.
Yes.
So if this impairment would not have been happening, if this impairment was never been there, in that case, आपके
20,000.
कितना carrying value दिखता?
20,000.
20,000?
Yes.
तो जो पास्ट में impairment हुआ, उसकी वजह से how much carrying value was reduced? 20 minus 10? If
Why,
the
sir? That is my confusion. That is where I stuck up.
okay, let me change the number. Probably from the number you are getting confused. Let me take this 1,20,000. So let me revise this example. So right, so I'm taking an example of 1,20,000. My depreciation is 24,000 every year.
Yes.
So this is my carrying value at the end of second year. My impairment is 30,000. 42,000 is my revised carrying value,
Yes.
right?
Yes.
Into this carrying value, I am charging a depreciation of 14,000 every year. And this is how my carrying value is there after charging the impairment loss. Right? And let me do this 1,20,000 calculation. If they have never done the impairment, what would have been? Kya hoti? Would
Yes.
have been my carrying value?
24,000.
24,000.
Yes, sir.
What is my carrying value? 14,000. मेरी है कितनी carrying value?
Yeah, that is 14,000. Yes.
That is 14,000. But
Okay.
this is a probable calculation. We are just thinking कि मेरे एग्जाम में कितने नंबर आते वर्सेस एक्चुअल में कितने आए हैं.
Okay.
Right?
Okay.
So my carrying value would have been 24,000, but है कितनी? 14,000. but मेरा recoverable value कितना है?
40,000.
So if I compare, you have to compare 40 with 40. What is the difference?
26.
So can I reverse 26,000? Can I add back 26,000 to my asset? Answer is no. Standard
Okay.
says you
Okay.
can compare this with this. You need to compare this with
This
this
with this.
while reversing your impairment. So
Okay.
how
So
much
difference is to be taken.
how much impairment loss I can reverse?
Okay. 10,000.
10,000. So out of 26,000, I can reverse only 10,000.
Okay. Got you.
I
Got you.
hope now it is clear.
Yes, sir. Thank you.
Okay. Any other question? So let me see the query box also. Thank you, Mr. Sayyed, for the feedback. Thank you so much. Yes, Abrikesh, please.
Sir, when will be your next class?
The next class will be, I believe,
Saturday?
in next week, Saturday.
Okay.
Yeah. So in that class, I will be covering Ind AS 23 also because there are only two
Yeah,
small periods, right?
Thank you.
Thank you so much. Thank you so much, friends. Bye bye. Take care. Session. Yes. Thank you.